Got about 30 seconds here, everyone, to let everyone join the room. Thanks for patience. We're having a bit of technical difficulties here for the last couple minutes. I'm dialing in from my phone, so I know we all love Zoom meetings and webinars. This is why in person, obviously, is always best. So thanks for your patience, everyone, and thanks for joining us, most importantly. Um, we'll get into things in a moment here, but did want to lay out a bit of the structure for today's discussion. I know a lot of the faces and names I'm seeing pop up on my screen here. This is a continuation of a lot of things, and thanks to those that are joining for the first time. Hopefully, we arm you with some intelligence and some forecasts on what we're seeing in the market, especially going into the fall and into the first half of next year as we start to see things change, especially as interest rates move. So thanks for joining us. We're going to spend roughly 45 minutes covering everything capital markets, investment real estate, debt markets, and with on office and real. We were hoping to capture an overview on multifamily, feeling like we were boiling the ocean. And so we really wanted to dial in on two of the main asset classes, but then regroup on retail multifamily and notice everyone when we're hosting that. But thank you for jumping on. We will be leaving 15 minutes at the end for some Q&A. So there should be a button on your Zoom meet for questions and answers. By all means, please populate and we'll capture those at the end. So without further ado, I'd like to introduce two very important people in our JLL team. Both are housed out of our Toronto downtown office. Introduce Matt Pickin, who leads our team for all of Canada, and Mr. Scott Figler, who is everything data-driven analysis and everything research for our Canadian company. And so hoping both Scott and Matt can offer not only the data point in the direction we think things are moving, but also live examples and tone from that on deals and activity they're seeing across the globe to give you some real examples. With that all being said, I will to Scott Figler to give a bit of overview of the overall market and dial into certain parts of it as well. Scott, the mic is yours.
All right, thanks, Mitch. Thanks for joining, everybody. So as Mitch said, I lead our research team in Canada. I've been with JLL for 13 years. I collaborated with Mitch a few years ago on a deep dive on the Southwestern Ontario market. And I'm very bullish on that market. And what I'm going to do today is speak to trends happening on a national level, but at every opportunity, we're going to try to tie it back into Waterloo and put Waterloo region into the national context of broader trends that we're seeing. So this is our agenda for today. We're going to start with kind of setting the table, looking at what's happening in the economy and how that's shaping the real estate market, capital markets, looking at investment trends, capital trends, liquidity, equity, and debt. And then we're going to do a little bit of a dive into the office market and the industrial market. As Mitch said, we do have retail and multifamily content, but we wanted to kind of keep it focused for today so we can send that out as part of a follow-up deck to our viewers. So on that note, we're going to start with the economy, and this week inflation's been in the news, so that seems like a great place to start. The number for August just came in at 2% year-over-year price growth, which is great news because it's the midpoint. It's sort of where we've been trying to get to for a long time, and now we're there. But as we know, the inflation index is a composite of many kind of subcategories of pricing, and so there's a whole spectrum of how different price buckets are performing. So this is a matrix looking at, what's green is showing price deflation and pulling the index down. What's red is kind of stubborn pricing and keeping it high. And you can see down towards the bottom, clearly the things that are dragging inflation back down to the target range are energy prices, which have been pretty flat and falling over the last few months. But on the other end of the spectrum, there's still issues in the housing market. Rented accommodation is up 8.6% month over month, and actually has been increasing over the last few months. So troubling signs, and it's a bit of a conundrum for the Bank of Canada, because if you raise interest rates, as we saw, you're choking off housing supply and developers' ability to get construction financing. You're also taking a lot of people out of that for sale market and putting them into the rental market, which boosts rents and contributes to rent inflation. But if you drop interest rates, then we're going to see a pickup in housing prices again. And there's also risks that that might reignite inflation. So it's a conundrum. It's a challenging problem, but we'll see where it goes from here. What we do know from financial markets is that we're clearly seeing a path back down towards interest rate stabilization. This is looking at financial market forecasts based on overnight index swaps for the US and Canada. So in Canada, we can see we're down to 4.25. Markets are pricing in interest rate drops reaching around 3.5% by summer of 2025 and around 3% by summer of 2026. Now, this could change, and it's not like these financial markets always get it right, but I think this is a good indication of where we might be heading over the next year. Now, how does this relate to commercial real estate markets? Well, this dark black line is the policy rate, which you can see has been falling a few times over the last few months. Now, bond markets are the critical piece here, because with real estate investment, obviously, we're all kind of benchmarking based on bonds. If you're looking to buy an office building or an industrial building and you need financing, your bank is comparing the rate that they're going to give you on that mortgage to what they would get if they just invested that money in bonds. So something very interesting has happened over the last month that's going to give the market confidence. It's not just that bond yields have fallen. So this is the 2-year in beige, and then the 5-year in dark blue, and the 10-year in light blue. It's not just that they've fallen in tandem, but there's a few interesting things happening here. Over the last month, 2 months, you can see there's some stabilization, and that's critical, because if you're looking for a commercial mortgage and there's volatility, even if there's a drop, you might be inclined to say, well, I kind of want to wait and see where things go. Maybe I'll get a better rate in a month, and it might cause you to pause on making a decision. If there's stability in the bond markets, that gives investors confidence that the pricing that they're going to get today is going to hold, and that it might be the best they can do for some time. So long story short, we're expecting this to feed into increased activity in commercial real estate markets on the investment side and on the leasing side. Now, I think it's worth talking about why the Bank of Canada is dropping interest rates. For those who've been on a call with me, I've been pretty vocal about thinking that they were going to hold off for a bit longer, and I'll kind of eat my words and recognize that that didn't pan out. I still, not to say that I think it's the correct decision. It's not really my place to say. I do think there's risks of a rebound because of geopolitics, because of different factors, but I think it's worth exploring why did they make that decision now. So the first one is the state of the economy. These blue bars are showing year-over-year GDP growth on a monthly basis. So, you can look at this and say, okay, we're up 1.8% year over year, and there's clearly some improvement happening since June, which is the last data point we have. However, the better metric to look at is this dark blue, which is GDP growth year over year per capita. So you can see this has been negative for over a year now. And what this means is that, taking into account the population growth that we've had in Canada, the economy isn't growing fast enough to keep up with the growth in population, and that's a problem. And now we're starting to see an increase in unemployment. So here on the right, you can see about 18 months ago, we were at 5% unemployment. Now we've jumped to 6.6%. We've also seen kind of stagnant job growth. We had 22,000 new jobs created in August, but certainly nothing to write home about over the last, call it 2 years, when you look at job growth in 2021. So the labor market is starting to soften, and we're particularly starting to see that with, we've seen in the news lately, some of the StatCan data that's come out, particularly youth unemployment rate and new arrival unemployment rate. So those things are showing that we're entering into a very soft labor market. The last thing that I think is, maybe the biggest factor in why they chose to drop interest rates now is housing, and particularly rental housing. So if you look at what's happening across Canada, these are two charts that speak to the multifamily rental market. On the left, it's vacancy rates. On the right, it's annual rental growth. So if you look on the left, rental vacancy is now sub 2% for pretty much every market in Canada. We're not just talking core markets, we're talking secondary and even some tertiary markets across Canada. When you're talking about London, Ontario at 1.6%, Waterloo region just above 2%. We're even starting to see drops in vacancy in the prairies, which traditionally have been very soft rental markets, very stable. If you look at Edmonton, in 1 year, Edmonton went from 4.3% vacancy to about 2.5% vacancy. Calgary had a huge drop, Saskatoon, Regina. And then if you look at rental growth, you can see some of these spikes. So Calgary went from 6% annual rental growth to over 14% rental growth year over year. We know Calgary has been benefiting from a lot of immigration. So this is top of mind for the government. If you don't have a healthy housing market, it creates all sorts of economic and political issues. So what did they do? They made a plan to create a certain number of housing units by 2031. And each province kind of set their targets as well. So Ontario set a target of 1.5 million new homes to be created by 2031. And each municipality was assigned certain housing targets to help meet that. So what this is looking at is just within the GTA, this is comparing for 2024 their provincial housing target that they were supposed to meet and where they'll probably end up. So if you look at Toronto, the goal was around 24,000 new housing units. This was first half of the year, and then the annualized pace. Toronto is on track to fall short of their housing targets by around 30%. Mississauga, 56%, Brampton down by 66%, and so on. There's only 3 municipalities in the GTA that are projected to hit their housing targets. So this is going to intensify the housing pressures, unfortunately. And a big reason why the interest rate cuts happened is because developers simply can't build housing at the interest rates that they've had to deal with over the last year. If for them to build, they need construction financing that's more affordable. So I think this was maybe the primary reason why interest rate cuts happened right now. And this is just a chart showing population growth in different cities. This is kind of a big story for Canada right now. Traditionally, you've had population growth primarily in the core markets, Toronto, Montreal, Vancouver. But because of the affordability situation, now we're seeing that the fastest growing markets in Canada are not those core markets. They're, in many cases, secondary, tertiary markets, often cities that are an hour and a half from Toronto, like Waterloo or like Barrie or London. Cities in the Maritimes like Moncton, and cities in the prairies like Calgary. Waterloo, Moncton, and Calgary over the last year are the fastest growing cities in Canada. So we have some takeaways. I'll leave this for the take-home deck. We have a nice little cartoon here of Joe Biden, which I find kind of funny. Victory over inflation, and the celebration balloons are now $35 each instead of 20 each. So I'll let you take a closer look at that in the deck at home. But we're going to keep moving. We're going to jump to the yeah.
Scott, if you don't mind me jumping in and just, tying it back, obviously Waterloo region in particular, really strong population growth prospects. I mean, we've made some pretty massive investments in infrastructure with light rail transit. Obviously COVID accelerated a lot of, the younger generation to move further abroad seeking affordability. But I would just add that whether it's an industrial-based tenant or an office-based tenant, hands down, the primary location determinant is labor and access to labor. That still, to this day, including for office space, is critical in their decision making. So, you can see the pressures there to come to a place like Waterloo Region, southwestern Ontario. You only hope that we can meet that demand with housing, which will ultimately fuel what the industrial and office users are looking for, which is quality labor and a really productive labor force. Sorry, Scott, to jump in. It just all
No,
this ties
absolutely.
back to tenants. Matt, did you have anything you want to add there?
No, I don't think so. I think Scott did a great job. Affordability is also a very big thing, and I think one of the things that you may have seen in the previous slide is the not just the population growth, but the vacancy decrease out in the prairies, and really the Calgary and Edmonton markets, which are really outperforming the balance of Canada. It's extraordinary to see how much growth there is, especially considering how much Alberta was suffering its own downturn, if you will, for the last several years, and it's making a comeback. And I think for a lot of people, it's nice to see.
Absolutely. So we're going to jump into a discussion of capital markets, investment trends, what sectors are outperforming, underperforming. I'm just going to set the stage, and then I want to get Matt's opinion on this. So we had a record year in 2022, 65 billion in sales. Just as a note, we're tracking only sales $5 million and up. But that's kind of our threshold that we're looking at. 2023, we see sales come down a little bit. We're now at about 20 billion so far this year, halfway through the year, on track for a year kind of call it on par with around 2016, 2015. The good news is in the second quarter of 2024, we saw a big jump in liquidity. Now that could be because of falling bond yields. It could be because the changes in the capital gains tax that sort of incentivized owners to liquidate before the deadline. But at any rate, I think given where bond yields are at, we're going to see a bit more activity in the back half of this year, which I know is a relief to many in the industry. That's kind of our house view. But Matt, I want to turn it over to you. Do you want to just speak to some of these different sectors and how investors are looking at them in terms of their level of conviction?
Sure. Thanks, Scott. And I think it's interesting to look at the historical graphs here. If you look at 2020, obviously that was a bit of an outlier given what was happening with the world. But 21, 22, and 23, record transaction activity spanning all the asset classes. And a few things happened during that time. And the one thing is, when you're looking at this chart, this is the aggregate transaction volume for all the asset classes. Well, when you think about what industrial land was trading at in 21, 22, 23, industrial cap rates, even office buildings weren't selling at quite the peak that they were prior to the pandemic, but values were up. Interest rates were close to nothing. Cap rates were equally low, and that was driving up values. Well, now we've seen everything kind of turn the opposite direction. Cap rates are on the way up, which is going to lead to aggregate values or transactions are going to be a little bit lower, come back into the historic mean. When you look at the assets on the right, I think what's interesting, we typically look at the four asset classes, so office, industrial, multifamily, and retail. And each of them have kind of gone on their own little path over the last several years. Office, we'll talk about a little bit later. Industrial has been the golden child, as has multifamily. We call them beds and sheds. But we've seen the emergence of a new asset class, and we call that alternative assets. And that can comprise anything from student housing to life science, to self-storage or to data centers. And we're seeing really it's a bit of a flock-like mentality with a lot of the institutions who are kind of chasing down these alternative asset classes. And I expect to see that bucket within the overall transaction universe continue to increase over the next couple of years. Not to suggest that the traditional four are going to go away, but I do think that investors are trying to branch out and really diversify their holdings.
Yeah, I'd agree with that. And I think it's worth pointing out, so with alternatives, it's kind of tricky because it's a smaller sample comparing over time, but you see 133% growth quarter over quarter. which definitely stands out. I would note the one negative here, quarter over quarter hotels. That's only because we had a massive portfolio trade of a hotel portfolio that traded in Q1, which kind of impacted that. But all in all, 43% increase in liquidity from Q1 to Q2. Definitely something we're going to keep an eye on in the next quarter. Thanks,
Hey,
Matt.
Matt, if you don't mind, I know we've got some tools for tracking bid depth. Obviously, you've got some fairly large offerings out there. How are you finding engagement, interest from buyers today? Is it up, down, flat?
It's a great question. So, and I don't want to steal the mic too much here. Scott has many more slides, but we do track something through a CRM-enabled platform, which Salesforce puts out. And over the many, many years, what we've done is collect the number of CAs or NDAs, confidentiality agreements, that are collected per mandate, spanning all the asset classes, spanning every single market. And we also track the number of bids per offering or per opportunity, we call it. And what's interesting is if you look pre-pandemic, we were collecting, I don't know, 50, 60, 100 CAs per mandate. And then during the pandemic, it went down, although it actually went up a little bit because people had nothing else to do but sign NDAs and look at opportunities. And then 21, 22, again, kept going up. We got lots of bid activity, and then things just stopped. Just absolutely stopped in Q1 of 2022, and that was coinciding with the interest rate movement going up. What we've noticed over the last several quarters is that there has been absolutely a spike in NDA activity as well as bids. This is particularly evident in the U.S. And in EMEA, so in Europe as well. But I would say that FOMO, and I had to learn that from my kids, but fear of missing out is definitely taking hold, especially in some of these U.S. markets. I think we're going to start to see an uptick or resurgence among investors who, as Scott said at the beginning, feel that they can take advantage of this new interest rate regime, and they want to get in before everyone else does. I think a lot of people also view that the knife has fallen to a point where we've hit kind of that dearth, if you will, or the valley in terms of value. So you're going to see some more investors, I think, that are going to jump in, and we're seeing that through empirical data that we're collecting.
Thank you.
Awesome. Thanks, Matt. So Matt just touched on it, how investors are viewing the bond market. These are two charts looking at what we would call, top tier loans for core product. Towards the end of last year, we saw terms kind of spike. Now we're seeing them come down a little bit. This is the 5-year, this is the 10-year, but definitely a good sign. And then if we look at liquidity by market, I think we're seeing some interesting trends. So the first thing I would point out, which I find interesting, is that the two markets where we've sort of seen I want to say kind of the most pause, sort of like relative to the size of the market, is Vancouver and Toronto, which ironically are maybe the two biggest investment markets in Canada. You can see in Vancouver over the last few years the drop. You can see in Toronto last few years the drop. I think some of that might have to do with the pricing levels in those cities, which might make it harder to generate yield when you're in a moment of kind of market dislocation, price discovery. But some of this kind of mimics or mirrors what we saw earlier about population growth trends and kind of the opportunities that we're starting to see in Canada and secondary markets. If you look at, this is something that we pointed out in our back when Mitch and I wrote that Waterloo report a few years ago. If you look at southwestern Ontario, you look Waterloo region plus Guelph plus Hamilton, not many people realize this is actually the fourth biggest investment market in Canada. It's bigger than Calgary, bigger than Edmonton, bigger than Ottawa. And we are seeing deal volume kind of on track to beat the 10-year average in that market. Calgary, we're seeing some momentum. We think this is going to be maybe the best year Calgary's had in some time, notwithstanding, a big portfolio deal that happened there in 2023. Montreal is having a good year, but also these other, you can see this bucket, other markets, kind of your Quebec City, Winnipeg, some of those cities are in this bucket. We didn't want to put them all in one chart, but you can see there's been some momentum there over the last few years as well. But again, we're pretty bullish over the next 6 months, 18 months to where this is going to go, but it just kind of gives some perspective on where money is flowing to around the country. And then I think one of the biggest stories that's happening right now, and I want to turn over to Matt and Mitch on this, is the types of buyers that we're seeing. Back 10 years ago, you look at 2012, 2013, 2014, pension funds were accounting for 10% of volume. REITs were accounting for 30, 40% of acquisition volume. You fast forward to today, private investors are accounting for almost 80% of acquisitions. So I think there's a lot of interesting kind of narratives in there. I mean, you can talk about how in a moment of market dislocation, I think what it comes down to is the ability to move quickly on opportunities that come up. And if you don't have to run decisions by an investment committee, you really have a leg up. Also, if you're not beholden to hitting a certain IRR for a fund, that's all. You also have a leg up. Like if you're looking to acquire assets to pass down to your grandchildren, and you're not so worried about the cap rate, I think that kind of buyer right now is really at an advantage right now. Matt, Mitch, are you guys, how is this playing out in your universe, the private buyer phenomenon?
Yeah, I'll start out. I mean, I think I'm definitely the old one of the three of us here from JLL, and I can tell you when I first got in the business, private buyers were doing deals in that $1 million to $3 or $4 million bucket, and now we're seeing really the boundaries have gone from 1 million to north of 100 million. We're selling some of the biggest assets in the country right now, and the bid depth is definitely not what it was pre-pandemic, but it's really the complexion of the bidders themselves. And privates are stepping up; they're stepping in. I think there's, as Scott said, there's this conviction that maybe they're near the bottom as far as values are concerned. And when there are fewer horses in the race, there's less tension. So they think that there's an opportunity to pick up these assets where they're not competing against pension funds, life companies, or asset managers. So, and I think the last comment is really the amount of dry powder that's been sitting on the sidelines. A lot of these privates are sitting on buckets and buckets of cash, and for the longest time, it's been earning very little in the bank or with GICs. Well, now is an opportunity to buy a real cash flowing asset that should be a hedge against inflation, where hopefully there's some residual value growth as well. So real estate was a bit of I don't want to say it's a four-letter word, but a lot of people got frightened of commercial real estate. But private investors have always been slightly ahead of the curve, and I do think that we're going to continue to see the privates that are going to step in and step up, and not just privates as well, but we are seeing offshore capital from a lot of these big family offices who are looking to get money out of the regions in which they live.
Yeah, I was actually gonna. Sorry, Mitch, go ahead.
I was just going to say, I think from a Southwestern Ontario perspective, no doubt places like Kitchener, Cambridge, Brantford saw a huge amount of Toronto-based capital flow out here in the big run-up. And there was a lot of institutional capital coming abroad looking for value. You definitely, through these cycles, see the tide recede. We don't see it receding to the same extent where it started before COVID, but at the same time, you have seen certain investors, institutional investors, and operators look to consolidate. And the flight quality is not just about the building itself; it's also about markets or perceived markets. So right now, we do see kind of this window where certain assets owned by institutions that are not core to their investment thesis are becoming available at a reasonable price, which is allowing more of the private local buyers to play. And we expect more of that over the next 6 to 12 months.
Awesome. Thanks, Mitch. So on that topic of, who's buying and what sort of metrics they're looking at, this is data that is really kind of shocking to me. So a lot of people on this call would know this, but if you're looking at buying real estate, the alternatives to that would be just investing in bond markets or stock markets or whatever. And generally, the benchmark is the 10-year Government of Canada bond yield, which is these bars in blue. And generally, historically, there's been a certain spread that you would expect to be kind of your compensation for the risk of owning and managing real estate versus just investing in bonds. Back, over the last 20 years, that spread in basis points has ranged from 260 in multifamily to 423 basis points on average for office. So again, kind of the spread of profit you'd expect from that. That's been compressing over the last 20 years to the point where the current spreads for, you look at multifamily, 140 basis points, industrial 283, office 460. Well, office is still a healthy spread, but Mitch, industrial is an asset class that is a head scratcher because there's a lot of acquisitions happening at cap rates that are, maybe not at that spread over the 10-year yield. Like, what's happening there? What's the psychology of the buyer when making that acquisition decision?
Yeah, and Matt, I think you're seeing it as well, more broad. Like, there is still conviction that there's rent growth to capture, depending on the size of the asset, the profile. We are still seeing transactions at below market cap rates if there is a shorter term lease where you can raise the rents. I mean, if you own an asset, industrial asset in a place like Cambridge, Ontario, your rents went from, generally speaking, $5 net to upwards of $12 to $15 net in a period of 4 years. And so because of that dynamic, it's simply a math equation. If if investors can get at those rents with what appears to be under 3 years, you're seeing trades at cap rates that are below that spread, with the conviction they will be able to capture the lift in the rent and the roll. Obviously, if it's a long-term lease in place at below market rents, it's hard to see those trades. Matt, I don't know if you'd add anything to that thesis out there abroad.
No, I would agree with it. My only comment is that the cap rates that we're showing here, this is based on a trend. So these aren't actual it's actually impossible for us to capture the data. This is based on what people would say, what would industrial building trade for if it's a 10-year lease, market cap rate in this particular market. And that's what the cap rate is that we're showing. In actual fact, I can tell you, because there's been very little trades in the office sector, for example, the cap rates we're showing here are somewhat misleading. But it definitely does show a trend, and I agree with everything Mitch just said.
Yeah, that's an important caveat. I mean, in Canada, we're dealing with a smaller sample of trades, so we are more beholden to survey data, surveys of institutional and private owners. But we also look at data from the U.S., from Europe, from Asia, where there's a lot more activity happening, and you can kind of generate a truer cap rate based on that. Okay, thanks, guys. So,
Scott, if you don't mind me, sorry if you're jumping in, and just I would say disclaimer of sorts and a word of caution. I think we're entering a time, whether it's leasing comps, transaction details, or sale comps, it's very important to understand the backstory, let alone some of the insights. And what we're seeing in the leasing markets is, whether it's office or industrial, incentives are up. The face rate, the net rent you may see is one thing, but the allowances, the free rent is and the insights. So I would just exercise caution. When you're just doing a snap judgment on a cap rate or a price per square foot, you really do need to understand the insides and outsides of the deal. So just travel wisely.
Absolutely. Okay, we're going to jump ahead. I see we have about 20 minutes left. I want to make sure that we have time to have a healthy discussion on office and industrial markets. So I'm going to jump ahead a little bit. I do have a little meme of Dwight Schrute here, which you can enjoy in the comfort of your own home. Okay, so what's going on in the office market? Before we talk about fundamentals, I think it's worth talking about these kind of tangential metrics and trends that we're seeing as it relates to hybrid work. Okay, so I think the first thing that we have to point out is, office utilization rates, which we define as, this is basically how many people are in the office relative to pre-pandemic. Okay, it varies greatly by global region, and there's some really interesting cultural differences in there that I think are worth pointing out. So Asian markets, Seoul, Beijing, Shanghai, Hong Kong, etc., they are much more active when it comes to employees being in the office. You see European markets, Paris through London, kind of in that middle tier, in that 70 to 90% of pre-pandemic level range. And then in North America, you see it ranging from Austin, Texas down to Philadelphia. So what's happening there? I think first of all, it's worth pointing out there is a cultural thing happening here. The biggest determinants of employees' propensity to work from home, it really boils down to the average commute time, um, the strength of the public transit system, um, and the average house size. You know, if you go, I have friends in Seoul, South Korea. The apartments there are very small, and people do not want to spend their whole day in those apartments. On the other end of the spectrum, in North America, you know, the American dream is, you know, a house with a backyard and a dog and a car, um, and really, really bad commutes on the freeway, right? So it's kind of logical that you would see lower adaptation in North America. Toronto kind of, you know, compares somewhat favorably in that context. It also has to do with coming out of COVID, you know, what cities had harsher lockdowns and which cities had softer lockdowns. So Texas, Austin, Houston, Dallas, higher office utilization rates these days, whereas other cities like Philadelphia, San Francisco took a harder line. Now it's kind of harder to get people back in. Um, Within the context of Canada, that also plays out. Where were there really harsh lockdowns? Ottawa, Toronto, those cities. This is data from StatCan showing the percentage of employees working mostly from home, defined as 4 days or 5 days from home. 34% of workers, as surveyed by StatCan in Ottawa, are working from home most of the week. Whereas Western Canada, Calgary, Edmonton, Winnipeg, a higher propensity to go into the office. Okay. So this plays out into the office statistics, which we'll see in a minute. Also, hybrid work, it's important to note that it varies a lot by industry. So, and I love this chart here because for me, this explains what's going on city by city, Toronto, Montreal, Calgary, Edmonton, and what cities are seeing more momentum in the office market. It also plays out on a sub-market level, and I'll explain in a second. So what we're looking at here is two charts for each industry. The top one is average in-office days for those companies, and the bottom chart is kind of their mix of strategies. And this is a survey of Fortune 100 companies. Okay, so I'll walk you through this. Energy and engineering companies, on average, their employees are spending 4.4 days in the office per week, and it's mostly a mix of office-centric and hybrid strategies. On the other end of the spectrum, insurance companies, 2.3 days on average in the office, and then you can see it's mostly hybrid, a little bit of office-centric, some team-dependent. Tech, you have a lot of remote first companies in there, and they're in 2.7 days a week. So what does this all mean? If you're thinking about this on a sub-market level, if that sub-market has a lot of tech and insurance companies, that sub-market probably saw a vacancy shoot up over the last few years. On the other hand, if a certain sub-market is big on energy, engineering, manufacturing, those companies are in more, and that sub-market has probably been more stable. So if you think about that in the context of, I'll just jump ahead here to, so if you look at some of the cities across Canada, where did vacancy shoot up the most? Toronto, where it went from 9% to 16%. Vancouver, Montreal, and Waterloo saw a big jump. Why? Insurance, tech, knowledge industries. That's kind of the core of those markets, right? On the other hand, you look at Calgary, it's been more stable. Edmonton has actually seen vacancy come down over the last year. And then if you look at the suburbs, they've been much more stable. Why? Because in the suburbs, you have a lot more of these kind of maybe manufacturing companies that have an office there. Big Pharma has an office there. Those companies have been in more, and so vacancy has generally been more flat in the suburbs. How does vacancy compare in Canada versus other global regions? Well, I think this is an interesting juxtaposition as well. You go back to 2007, office vacancy in Canada was around 7-8%. It was one of the lowest in the world. It was up there with Asia Pacific markets, which, as we saw, are very big on the office, right? You fast forward to today, Canadian office vacancy, we have it at 17.2% nationally, one of the highest in the world. So obviously, COVID was a big part of that. And now only the US has higher office vacancy than Canada. Of course, worth reiterating, this is very dependent on the city, on the market, on the submarket. Now, where are we going in the next few years? I think this is kind of an interesting point to touch on. So these light blue bars here are new supply. The beige bars are net absorption. So you can see 2020, 2021, net absorption was at historic lows, obviously after COVID. 2022 was a bit of a recovery for net absorption. And then 2023, we saw another hard year because of what happened with interest rates. Okay. But what's going to happen over the next few years, these bars here, which show new supply, it's basically going to go down to zero. There's pretty much going to be zero office buildings under construction being delivered beyond 2027. What that's going to do is give the market time to recover. It's going to give time. It's going to give an opportunity for tenants to make their decisions and sort of catch up. There's not going to be more buildings going in, as we've seen. A lot of the new buildings that are going in or that are coming onto the market are pulling tenants away from other buildings that can't fill them, and that's the biggest source of rising vacancy, is in those backfills. So that's going to be an important dynamic. Now, what's happening with rents and downtown and the suburbs? I think this is another interesting story. There is a certain flight to quality that's happening that's undeniable. We've actually looked at absorption on those dimensions, and it's very clear that tenants are flocking to newer buildings and better amenitized buildings. But what's also clear is that over the last year, we are starting to see net rents fall in downtown Toronto, fall just a little bit in Vancouver and Montreal. So even in those markets that are dominated by institutional investors, we are starting to see a little bit of fall off in the rents, just because rising vacancy is starting to kind of take its toll. But again, it's a bit of feast or famine, because you have a certain segment of the market that is outperforming. Those trophy buildings are continue to command a lot of the demand. To summarize what's going on in the office market, there's certain tailwinds that are favoring landlords. There's headwinds on the market that would favor tenants by making the market sort of softer for tenants. These are kind of the main trends. So for what's happening, that's kind of tilting it towards landlords, the flight to quality trend. If you're a landlord that owns a strong asset, well amenitized, there's going to be demand for your building. We are seeing positive absorption in strong nodes, particularly in the suburbs. New supply drying up beyond, over the next few years, which we talked about. And then interest rate hikes in the past, that should stimulate demand, stimulate the economy, and it should trickle down into more office demand. However, the factors that are what we would call headwinds are kind of outweighing the tailwind factors. So these are, lack of available and affordable debt financing for the office market, entrenched hybrid work, macroeconomic uncertainty, and another phenomenon which is worth noting, the growth in sublease availability. So this is worth just diving into a little bit, because construction costs are so high right now. If you're going into a brand new office building, that's a space that's raw, are you going to spend $300, $400 a foot to build it out? When in Toronto, there's 8 million square feet of built out space on the sublease market, you could do a plug and play space there, buy yourself 2-3 years of term to make your long-term decision and not spend a dime on the fit out. Right now, we're seeing that tenants are going with the latter. So the high sublease availability has been a huge factor in the market. So now we have just over 10 minutes left. I want to spend the last portion discussing the industrial market and getting some thoughts from Matt and Mitch on this. So the first thing that we're seeing that's worth noting, and Mitch, I'll turn to you in a second, but net absorption, these blue bars here, 2 consecutive quarters of negative net absorption in the industrial market, which 2 years ago would have seemed unfathomable. Now we're seeing it, but correct me if I'm wrong, Mitch. It's not so much that these tenants are downsizing. That's more about new buildings being added to the market with lower occupancy. Would you agree with that statement?
Yeah, I mean, if you use Kitchener-Waterloo, Cambridge, Brantford, you've had upwards of 4 million square feet come deliver in the last 6 to 12 months, and will be delivering over the course, the rest of this year and into the spring. Point I'm trying to make is you had a very large wave of large box supply. Let's be clear. There's no vacancy in small bay industrial. No one was building smaller bay industrial buildings. And so you do have this large wave of new supply delivering, not just in places like Southwestern Ontario, Milton, GTA, every North American industrial market saw the same effect. And what, similar to the office landscape, we have all but seen industrial speculative development stop. The math doesn't work. Land values have settled, but not to the point that they justify the risk. And so we do anticipate full delivery of all new space. We do anticipate we're likely going to see the highest level of vacancy come Q2 of next year. And it's up. I mean, we've gone from an industrial market, which had a sub 1% vacancy level in the GTA and in Southwestern Ontario. We're likely trending towards a 5 to 6% vacancy rate over the course of the next 6 months based on new deliveries. And so with all that, one of the other markers, Scott, you mentioned the office market, sublease market. We are seeing sublease availability, which obviously makes it tricky to compete as a landlord. But it's a very defined segment in the way of 3PL, in particular in Toronto. If you look at sublease vacancy in the Southwestern Ontario region, we really don't have any. All of the vacancy risk is coming from these new deliveries. And so office, we're going to chew through it. It may take some time. Part of the issue is it's larger base spaces, right? Go drive around Cambridge, and most of these buildings are 300,000 or 400,000 square feet. You can't split them up to accommodate a 30,000 square foot tenant, which is arguably the sweet spot size for most tenants in this market. And so I think it's important, like comps, to really dissect the various parts of vacancy, because we're actually seeing rent growth in spaces under 50,000 square feet, whereas over 100,000 square feet, we are definitely seeing it come down. I hope I answered your question there, Scott, but that's a trend here in Southwestern Ontario. It's a trend abroad as well. I don't know, Matt, if you have any thoughts on the industrial landscape.
No, this is your domain. I would just say that industrial still continues to enjoy most favored nation status amongst investors, because it's the easiest, well, it was until recently, the easiest asset class into which investors could get a hold. But as values, and I don't know, Scott, whether you show it, but industrial sale price per square foot has now eclipsed what suburban office is trading for on a per square foot basis. So this new paradigm is interesting. It's something that I'm certainly not accustomed to. You can see back in the early 2010s and all the way going back to as far as the data has been tracked, industrial has been the lowest. But now we've seen that turn upside down. It will. What's not shown in the office price per square foot is the amount of TIs that investors or owners are having to put into their buildings. So that number is a little bit misleading as well.
Yeah, but sorry, I'm jumping around a little bit. I'm trying to follow the discussion, but I find this just crazy that industrial pricing is basically on par with suburban office right now, at least in the GTA. We're seeing this in Montreal and Vancouver as well, though, which is interesting. Okay, I'm going to jump back here because I think it's worth just diving a little bit into the fundamentals and talking about the scale of what's happened in the industrial market. I find it fascinating. So if you go, this is going west to east across Canada, you can see pretty much across the board, starting in 2021, this huge ramp up in new supply coming out of COVID, we were all buying Pelotons or, new TVs or whatever. All that stuff needed to be stored somewhere. Everyone was shopping online. So that was primarily, not primarily, well, I think the biggest demand driver, I think it's safe to say, was e-commerce, although there were other segments of demand in there. But you just see this ramp up in new supply. Vancouver going up to 6 million square feet in deliveries. Calgary going up to 7 million in 2022. Even Edmonton, Winnipeg was a little not as aggressive. Waterloo region, Mitch touched on the wave of new supply there. And then Toronto in 2023, we saw around 17 million square feet of new industrial supply hit the market. Montreal the same, and then Ottawa's a little bit of a different story. But then meanwhile, you look at the demand side, looking at annual net absorption, you can see it start to fall precisely when the new supply hits the market, which, that's real estate, right? Like you can't always time the market perfect. But so Vancouver, you see net absorption turning negative so far this year after, 6 million square feet a year. Calgary, you see a spike in demand. Edmonton, you see a spike and then a fall off. Winnipeg, the same. Toronto went from around 16, 17 million square feet in absorption in 2021 to negative absorption this year, and then the same in Montreal. Again, I think it's worth reiterating, that isn't tenants shrinking their footprint. That is mostly due to all this new supply coming on with more vacancy in it. As Mitch alluded to, the large bay buildings with a lot of vacancy in it, that's driving up vacancy for the market. Now, my view on the industrial market is, and I'll shift to this chart where we can see, this one where we can see vacancy rates kind of going up across the country. My view is we're going to go through, the next year, call it year 18 months of rising vacancy, as Mitch was discussing. But at a certain point, Canada is still, like, Canadian markets are still harder on zoning than the US. We're still land constrained. Look at Vancouver, look at the Toronto Greenbelt. There's still, geographic restrictions, zoning restrictions. So, there's a good chance that in 2-3 years we might be right back in a landlord favorable market, where demand is outpacing supply. I think it's just right now where the economy is slowing down. We have all this new supply coming on. I think we're going to be in a window, 12, 18 months of softening, but I don't think it's going to last that long. Mitch, would you agree with that?
Yeah, I know somewhere in the deck, Scott, there's a piece on user purchases and the volume of user purchases. I think one thing we're likely to see with this increased vacancy as well is more user purchases of buildings they already occupy, or instead of leasing, have the Business Development Bank of Canada, whoever it is, finance a purchase acquisition. We've seen record levels of user purchases relative to other investor purchases in the last 12 months, and do expect that to continue, just as the government tries to stimulate especially the manufacturing sector, and interest rates are coming down while rental rates stay relatively elevated. So we do expect more of that as well to chew through some of the vacancy.
And then just a quick note on rents. This dynamic of the supply crunch after COVID and falling vacancy, you can take a look at what this did to rental growth in Vancouver. So these are net rents on the left, and then rental growth on the right. So you can kind of compare between the two. So Vancouver, you went from 15 up to around 22. 32% rental growth in Vancouver for this year, for 2021. Waterloo region, went from $8 to 15. Waterloo region saw rental growth in the, collectively, I don't know, it looks like 50-60% over those few years. Toronto and Montreal had some of the highest rental growth in the world from 2021 to 2022. I think in Montreal it was something like 60% rental growth. So you're going from $8 to 15 or something like that. I mean, it's been really astonishing. And I would add on that, and I'll kind of conclude with this, and then we'll kind of leave it open if there's any questions. But I see what's happening in the industrial market is healthy. I back in 2021, everyone was clamoring for new supply. Um, we've gotten it, and now vacancy is stabilized, rental growth is stabilized, and by the way, that's a big reason why inflation is stabilizing, because the cost of warehousing, the cost of supply chains is kind of coming back to earth. So um, no need to fear if you're an industrial landlord. Okay, so Mitch, you had a question?
Yeah, I would say it's important to keep in mind the long-term, and fairly well-known healthy vacancy level, a balanced market is 5%. And
Right.
so we may slightly overshoot that, just because of manipulation of interest rates and trying to control inflation. But we also may see when we shut down construction, as long as we've had, we may see it tighten up very quickly again. We're already seeing that on smaller product, where the vacancy is still low, and now it's non-existent in new developments. So yeah, I do expect it to rebound. And you're already starting to see with rates coming down, a lot of tenants also were on the sidelines deferring decisions. You're starting to see them come back in as well. So I don't want to overstate it's a tidal wave of activity, but no doubt, like buying activity, you're starting to see the tenants also for industrial start to wade back into the waters here.
Great. So I'm going to stop there. I mean, we're almost at 10 o'clock, but Mitch, do we want to see if there's any questions from the audience?
Yeah, and I checked the Q&A. If anyone has one, by all means, I know most are on a fairly tight schedule. If anyone needs to jump off, maybe if I can, Scott and Matt, the one thing that I know I'm getting a lot of calls on is the idea of distress. I think there's a lot of hope in a way that there's opportunities to buy things out of distress. What are you seeing in the way of distress, power of sales? What asset classes, where, what does that look like right now, and what do you expect going forward?
I'll take this one, Scott. I would say that without question, we are seeing more stress. There is some distress, but there's more stress. When I think of distress, I think that there's blood in the streets and pianos are falling from the sky. Without question, we're seeing an uptick in the number of phone calls that we're getting from receivers, from insolvency groups. But if you were to isolate it to a certain asset class, again, without question, it would be mostly within the land space, land sector, development land. This could be, and it's predominantly residential development land, to be candid, whether that's for purpose-built rental or for condo, and irrespective of the market. We've seen in downtown Toronto for high-rise condo. We've seen low-density sites within the periphery of the Greater Golden Horseshoe. And really, this is a function of groups who bought this land at maybe the peak in 21 or 22. They locked into their financing, and maybe they weren't able to get their entitlements. Maybe construction costs that they budgeted were much higher than forecast. And then on the other side of the ledger is that you don't see the revenues. People just simply are not buying condos. They're buying houses, but not at the pace at which they were doing it beforehand. And that's really a function of interest rates. So it's this kind of cyclical effect. And quite honestly, there are some really good developers that have gotten themselves into trouble through no fault of their own. There's some bad developers who also got themselves into trouble. We're working on the most high-profile receivership in Canada right now at the corner of Yonge and Bloor. What I can say to you is that for the most part, if you look at the profile of owners in Canada, and let's look at office buildings or industrial, we have some of the strongest owners across the country, pension funds, very strong balance sheets. They can weather the storm. So I'm not overly as concerned about Canada as maybe some of the other countries where you have more fragmented or disparate ownership.
I agree with that. And Scott, I'm trying to be mindful of time. Lots for the next 6 to 12 months. I hope we gave our audience here a level of data and kind of a glide path where we see things so they can prepare for whether it's acquisition, mindful of what's in store for us. Any final thoughts, Matt and Scott, going into the next few?
All I would say is, we're in. I mean, I don't want to date anyone on this call, but Matt, you've been in this industry longer than me. You're still a young guy, but you have been in this industry longer than me. Not to say I'm that experienced. I've been working in this industry around 15 years. I've never seen a market like this. I think we're all trying to, leverage the best information we can in real time. Um, I don't know what the 90s were like in Canada. I wasn't up here working here at that time, but I think it's just now more than any time I've been in the industry, it's really, really important to stay informed and to, you know, uh, really kind of think about the nuances that are happening and not buy into the alarmist headlines because there is a lot of opportunity out there. And we hear a lot about, in the Globe and Mail every other day, there's a article bashing the office market. I mean, yes, vacancies going up, but there's still millions of square feet of leasing that are happening every quarter, right? So stuff's getting done, and there's opportunity out there, and you really need to be nuanced and thoughtful about your approach now more than any time I've been in the industry.
And just to add to that, what I would say is I think it's an incredible buying opportunity. But this is, and I am the old guy on the call. When I got in the business in the 1990s, we were coming out of the mid 90s recession where office buildings were being picked up for 5% or 10% of what the value was, their appraised value, cents on the dollar. Industrial buildings were being picked up for $15 a foot. I think the lending standards have matured. Ownership profile has gotten better. It's not as bad, but I do believe the office market is going to continue to be impacted. I think a lot of people on the investment side are going to have to pivot to more asset management and be hands-on, speaking to your tenants on a more regular basis, understanding their space requirements, the parameters through which they want to lease space or consume space. Things are changing really, really quickly, but we're disciplined market. We have strong ownership, and this business is cyclical. So where some people might look at this as distress, as awful, I view it as just a fantastic opportunity. And it's a great time for younger people in the business, whether you're on the advisory side like ourselves or on the ownership side, to learn. What a great time to learn. It's like a free MBA or a CFA on the fly, albeit an expensive one. But yeah, exactly.
Well, gentlemen, I appreciate all you do. I appreciate your perspectives. I hope our audience got some nuggets that they can take away. Just looking at our time, we've gone a bit beyond. So thank you to everyone for jumping on. Thank you, Matt. Thank you, Scott. We will be circulating a much more detailed deck. As Scott mentioned, it'll include retail, multi-res, and we are here to serve. I mean, if we can ever support, even on an advisory basis, any questions around the market, comps, we're here to help, guys. So by all means, feel free to reach out at any time. We're here to be a resource. With that, thank you for hopping on. We'll be in touch soon.
Thank you.
Thanks, everyone.
Thanks, everybody. Have a good day.
Bye.